Hey guys, welcome to another Ultimate Edge webinar series, this time backed by popular demand, Tom Howell. Tom, how are you doing?
I'm doing great. How are things in your world?
Our world is great. We started a little late here, guys. Sorry about that, those of you that are watching the webinar. But we are recording it. We can send you this later if you want, and for other people. So let's dive right in, Tom. Tom, for people that don't know you, maybe from the previous webinar, can you give us a little overview, first of all, of your background and what you do and what you're interested in? I know there's a lot there, but bring us up to speed.
Okay. Well, for 30 years, I've been a tax accountant, mostly working with people in the real estate industry, both investors, realtors, and anyone associated with the industry. And for about 20 years, I've been investing in real estate, doing flips, partnerships, and now I'm moving into creating an investment fund and just jumping back into acquiring assets. So
that's a very short version of a lot of experience there, guys. I want you to know that. So last time we kind of talked about an overview, and I think the theme of that whole discussion was there's ways to set up entities and using real estate to optimize your yield and protect yourself and all of that. That was the first experience with Tom Howell. And from that, we got a lot of questions, and thank you guys. And for those of you on the webinar right now, if you look at the bottom of your screen, there's a Q&A portion down there, and there's also a chat box. Either one works for me. If you have a question in mind, just type that in while we're chatting with Tom here, and I'll ask him as we go, and we'll go from there. So Tom, we decided to focus this time on capital structures, but I think that begins with something you called the wealth triangle. Is that right?
That is. So I have some slides to share.
All right, perfect. I might have to try going to the bottom there and see if I think you can put the slides on the screen. If you hit the share down below there, you should. There you go.
Does that show?
That shows your wealth creation pyramid. That's perfect, Tom.
Okay. Very good. So some people may have seen this before. One of my mentors, George Antone, wrote a great book called The Debt Millionaire. And a lot of this information he presented showing that how you manage your debt is how fast you can become wealthy. And so through this wealth creation pyramid, we start with the asset side, up where the little red house is. And we've all read the books or taken the courses that told us how to buy different types of assets, whether it's rental properties, tax liens, doing lease options, buying cryptocurrency. Whatever asset you choose to buy, there's plenty of information on how to buy it. The other side of that pyramid is the capital. And again, we've read the books and taken the courses on how to find private money, how to get seller financing, how to get a mortgage, put a syndication together, so forth. But the piece that's usually missing and where most people find themselves slowed down in their wealth creation endeavor is how they structure the capital. And in that realm, we talk about things such as debt coverage ratio, break-even ratio, the capital stack, which I'll show you next, and the spread, which is really the game that we're in, is acquiring spreads, the difference between income coming in, income going out. What's in the middle is left for us. Does that make any sense to you, John?
It's a great beginning, Tom. Yeah, you have me. Guys, I have not heard this from Tom before, so this is all new to me. I'm going to be taking notes just like you. It's interesting, Tom. Keep going.
Okay. Yep. Okay.
Yep. You're good.
Getting my thing. Okay. So here's the capital stack, and this is my version. You've probably seen this in a more simplified way. And it tells us that if we buy a house, the house value is that orange stripe on the left. We buy a house, we use some part of debt and some part of equity to acquire that home. And the capital structure is actually how we create that capital stack. And there are reasons and there are mathematics behind what we would do and why we would do it. And part of it is managing the risk. So you see the risk on the right-hand side. Usually when you get a bank loan, let's say you get a bank loan for 70 cents on the dollar of the value of the property, that is the safest place to be in the capital stack. There's all that equity above you that secures your place. And that's why the banks are always in that first position, in the safest position. The next place, which is my favorite place to be, is actually in a junior note or preferred equity space. And I can explain that later as to why that is where you can really get some enormous returns on your money. And then as we buy into our assets, usually it takes some portion of our own money to buy into the transaction. And so through that capital stack, we're able to acquire assets, and then there's a technique to making the capital stack work so we can buy asset after asset after asset without draining our own resources. And that's part of what we want to talk about.
Now, Tom, you're probably going to jump into this, but you mentioned where you like to be is the junior note mezzanine second position. Does that mean that on a property that you determine you want to use this capital stack structure and bring in some preferred equity partners, that you may lend the money in a second mortgage position yourself? Is that correct?
That's correct. Second mortgage position, or I would buy into what I call preferred equity. So there is a maximum amount of debt that a property can actually absorb. And I'll go through the math on that in a couple of slides.
Got it. Okay.
Above that level of debt, you have to use equity, but it doesn't have to be all your money. So you can bring partners to the table and secure those partners in a way that they are actually ahead of your own money in the transaction.
Okay.
The higher we climb the capital stack, the greater the compensation for the risk that's taken. So a preferred equity partner should get paid much more income than your junior note would get paid, which again is much more income than your bank loan.
Makes sense.
Okay. The thing that throws most people is the categories of assets and what they buy into. And this is where I see people stall a lot. There are really 6 categories of properties. We have stable assets, and then we have volatile assets. We have assets in both categories that produce only income, some that produce only growth, and some that can provide both. We are actually fortunate in our market here that single-family homes are providing enormous growth and income potential. And actually, the growth is what will make you wealthier in a Seattle market house rather than the income.
There you go.
So I put some assets in those various boxes to show you what type of assets might be there. And what throws most people is the fact that single-family homes show up in the volatile section. And that's primarily because if you get a month or two of vacancy, you have thrown your entire year's profit out the window. So that asset has great income variations because it's a single tenant property. So we actually can do better by buying into commercial, multifamily, mobile home parks, promissory notes. Things like that are actually much more stable and therefore can absorb more debt and also absorb and have less risk.
Okay, got it.
Does that make sense?
Got it, yeah. And now, just for small clarification as you move along here, so are the more volatile assets there producing a higher yield because of their volatility? Is that correct?
They may produce a higher yield, but with that swing in yield comes more risk.
Right.
Right? And so certainly we've seen assets in 2008 and 2009, assets plummeted, right? So what we thought was secure real estate actually fell in value, and people who were not prepared for that drop in valuations are the ones that suffered the greatest.
Yes, absolutely.
Right? So those that managed their debt levels, had their reserves, had positive income on the properties, they flew right through the crisis without much problem.
Okay.
So that's what we want to talk about, is how do we manage risk so we don't suffer those setbacks.
Absolutely.
And
Yep.
buy better assets. And this gets a little technical, so tell me if I'm getting too brainy on.
We'll let you know, Tom. Let's bring it on.
So the first thing we do when we want to look at an asset is categorize it. Where does it fit on this matrix? Is it stable? Is it growth and income? that tells us how much debt and how much risk we can take on that asset. So once we've identified that, we then move to calculating the maximum level of debt that an asset can handle. And this is done every day in the commercial world, but you rarely see it done in the residential world. And it really should be done because the residential properties can swing in value as more than a commercial property with stable cash flows. So, John, I'm sure you know what the debt coverage ratio means.
Yeah.
For a lot of people that do single-family home investing, they may not have heard of that or don't know how to calculate that. So it's really about how much income does that asset throw off versus the payment amount that we have to make to the bank or to our debt. So for single-family homes in a strong market like Seattle, we would not want to be lower than a 1.15 debt coverage ratio. We should be able to absorb a little setback in rental income or valuation and fly through that no problem. The break-even ratio actually takes into account the loan plus cost of operating the building. So both those ratios come into play in telling us how much debt a property can hold. And it's surprising how low a Seattle home can be financed and make these ratios work.
Low meaning small loan amount relative
Low loan amounts, low loan to value.
Low loan to value. All right.
Right. So it was all the rage 10 years ago to get 95% financing on a property. And we saw how well that went. Right? So we want to make sure for safety reasons that we have a maximum level of debt and we don't exceed that level.
Okay, that makes sense.
Okay.
In the multifamily world where we do loans, this is exactly how it's looked at.
Right. And what we want to look at and what I want to coach people into doing is moving up and beyond single family homes. It's a great place to start. I see people hang on to assets longer than they should. So there's actually a curve of yield, and your yield falls the longer you hold an asset. So 8, 9, 10 years is a perfect time to hold an asset and then get out of it and move on up to bigger assets. And that's how you build great wealth.
That, Tom? Are you going to explain why that's the perfect time and why the yield is getting lower?
Well, it gets a measurement of return on assets versus return on equity. So as the asset climbs in value, you actually are getting a lesser and lesser return on that value.
Okay. Yeah, makes sense.
Right. Also, your depreciation starts to, because of inflation, this straight line depreciation becomes less valuable over time.
Right.
Whereas if you can buy a new asset and create the depreciation deduction from the beginning, we now are doing it with current dollars rather than nominal dollars.
Okay.
It's a little bit, it gets a little bit deep.
No, but it all makes sense. I mean, to me it does, and I'm sure we'll get some questions from the audience here if they want clarification.
Okay. The next piece that we have to do is we calculate the spread on the deal, and this is really the game that we're in, is buying spreads. And by doing that, I mean we get an NOI percentage out of an asset. We want to make sure that that NOI is greater than our payment.
And for those people who aren't familiar with that acronym, Tom, what is NOI?
Net operating income, which is the income from the asset less its operating costs before debt service. So typically you'll see the bank underwriter will take 75% of the rent and calculate that for your debt ratio. They're assuming a 25% expense ratio. So in that case, you have 75% of the revenue left to be able to make your payment. But we want to measure it in terms of percentage rates. So if we have a cap rate at 7% and a mortgage rate at 5.5%, we have a 1.5% spread. That's not bad for a real estate deal. 1 to 4% is the absolute goal in spreads.
Okay.
Does that make sense?
Yeah, I'm sure you're going to develop it even further, but yeah, absolutely.
Well, it's a measurement that few people do, is to look at the spread, but it's the spread that makes everybody wealthy over time.
And now, how do you determine the cap rate to determine the spread?
We take the net operating income from the building and divide it into the purchase price of the asset. And that tells us what the NOI is as a percentage of the asset value. So when we have a 7% cap rate, that means that the building, if it was paid all cash, we'd be getting 7% of that purchase price back in cash flow.
There you go. So Tom, that's just one of those great around the barbecue conversations things with real estate investors. What's a good cap rate, and reflect the market you're talking about? Like, what's a good cap rate in Seattle versus maybe some other market that has a higher cap rate?
So in Seattle, cap rates are 5 and 6% usually, particularly in the heart of the city. Maybe even 4.5. As you get farther out, when you start getting into the suburbs, you're going to be getting 5s and 6s. If you start buying houses in some of the Midwest cities, you can hit 7 and 8% cap rates. Assets that have cap rates greater than 10% usually have risk with them. So you might get too much of a good thing because the asset is not stable.
Mm-hmm.
Or there's something wrong with the asset that the income is going to be that great on the investment.
All right. So is it correct that another term for the capital, excuse me, the what are we talking about here? Is yield. That's where I'm going with this.
Yeah, yield. The yield on your investment before debt service is what NOI is.
Yeah.
So if you want to calculate yield, you could do that.
Is cap rate kind of a synonymous with yield for you?
It is.
Okay, fair enough.
So in that case, we would want yield, the percentage of yield, to be greater than what we are paying in loan constant as compared to debt size.
Yeah, got it. So the bigger the spread, the better the yield.
Yes. Which is why if I was going to counsel somebody on getting a mortgage, I would have them get the lowest possible payment for the maximum amount of debt.
So it's not about rate so much as it is payment.
Payment. The loan constant is the payment amount. And so a 15-year mortgage, even though it sounds ideal, actually puts you at greater risk than a 30-year mortgage.
And if you extend it out further, Tom, does that mean you're a fan of interest-only loans?
I'd love interest-only loans.
For the obvious reason that the payment's lower.
The payment's lower. You can always amortize an interest-only loan by making extra payments. You can always turn a 30-year mortgage into a 15-year mortgage by paying more with each payment.
Got it.
So you are in control. But if the market has a setback and you have to go and survive, you want the lowest possible obligation to the bank. So we are shopping for the lowest possible loan constant to give us the maximum amount of safety in the transaction.
Very good.
In a growth-only asset, if you were going to buy land, hold it for development, and you were going to use debt on it, which is probably a no-no, but if you were to use debt against that land, you would want to make sure that it's appreciating greater than the interest you're paying on that debt. Otherwise, you're digging yourself a hole.
Yeah, that makes sense.
Right?
So you're going to have to just go with where you think appreciation is going to go over the next 5 years from when you're buying that land. Right.
And land is not necessarily all that stable unless it's really in the urban areas. If you were to, you're going to go buy agricultural land, it does not appreciate too wildly unless you happen to be right on the edge of a growing city.
Very good. Okay, what's next, Tom?
So we've calculated the level of debt, then we've calculated the spread, and then we have to deal with reserves. And the reserves is the secret that everybody misses of what they should do with their own capital. So by having a lot of cash on hand, it gets you to be more qualified to keep purchasing assets. Do you agree as a mortgage broker?
We love to give loans to people that don't need to borrow money. That's exactly right.
So when you have your cash sitting there in the bank as that safety that safety bucket of cash, the bank's willing to give you a loan more often on more assets so you can buy quicker. So what people do is they spend themselves down to nothing to get into that first rental property, and then it takes them years to save up enough money to do the second one, and years again to do the third one, and so forth. Whereas you could actually be buying at a pretty good clip if you were able to maintain your reserves.
Okay, and so I bet you're going to tell us what the best path to do that is, huh?
It is. So we calculated based on number of months, taking the operating costs and debt service for each property and doing its own calculation of how much cash we need to have in the bank to support that investment.
And Tom, just to make sure we're on the right slide, the slide hasn't changed. Are you changing slides at all on your side?
Oh, sorry. There's the spread. Did you not see that one?
No.
Okay. So that's the slide I meant to have for the spread. And then reserves is here. Reserves are the best use of your capital. By having sufficient cash reserves on hand, you're able to get the maximum amount of loan that the property can support. And it increases the velocity of which you can buy into the assets. So we calculate reserves as a number of months of both operating costs as well as the debt service. And we maintain a bucket. We don't share the dollars. You can't have $10,000 for one property and have $10,000 for another property all in one $10,000 account. If you have two properties that each need 10, you need to have 20 grand in reserves.
Okay. Makes sense.
As you bring on partners, as you bring on equity partners or debt partners, their risk is reduced when you have increased reserves. And so it makes it easier to sell your investments to these partners by having large reserves. So your reserves can be sourced from your own cash. You can certainly get a reserve from partners. So you can over subscribe to your offering so that you can put some cash in reserves from your partners. You could invest your cash into a cash value life insurance, and then when necessary, you can get a loan against those cash values. That's one way to actually stack yield, is to put your money in places that it can make money but not be at risk. And if you have secure lines of credit, which is not all that common because lines of credit have a history of getting compressed at times. So you can't have a $200,000 HELOC and know that it's going to be there in bad times. So that may not be the best place to get your reserves.
Yes, that's what happened in 2008 and 9.
Yeah, everybody thought, oh, I'll just borrow it against my house. But then the bank said, no, you're done. So we were all helpless. And so to wrap it all up, this is basically the investing system that you need to put together. Your job is to be the portfolio manager. You're at the top of the game. You need to be designing your portfolio around how much income are you looking to make, how much growth do you want to make. Growth assets will actually make you wealthier than cash flow assets in most places. So certainly a $600,000 house in Seattle appreciating at 6 or 8 or 10% that we've recently seen, you're making $5,000 a month in growth on that asset. Rented with debt, it might make a few $100s of cash flow. So it's the growth assets that make you wealthy. It's the income assets that help you hold on to the growth assets.
Yeah, it's hard to make the mortgage payments with growth assets.
It is. So that's why you need to have a mixture of both. And you need to be conscious of what your mixture is and how do you have to put it together. And that's your job as portfolio manager. So you're looking for assets. Any asset that produces cash flow can be turned into a good investment if you do the capital stack correctly. So how much debt do you put on it? How much equity do you have into it? And how much reserves do you have set aside? And certainly building a team with your real estate attorney, your mortgage broker, your contractor, property manager, bookkeeper, accountant, and realtor. Everybody needs to be supporting your portfolio that you are managing. So it's not just you holding a house or two hoping and praying that it one day makes you wealthy enough to retire. It's about actually having a plan, laying it out, and managing that portfolio. And you can become wealthy in a surprisingly short amount of time if you put your effort into that portfolio management.
Define a surprisingly short amount of time, Tom. And let's say you're starting as a beginning investor and you got a little bit of money maybe, but not much. So you don't have a lot of reserves, what you're talking about. You have enough maybe for a down payment on something, and you don't have any partners. And so you're starting to look for partners so you can have some funds. What's a reasonable expectation there?
10 years. I would think most people could replace their current income in 10 years.
Okay. Got
Less if you're willing to hustle and learn. You know, if you were to put together a big syndication that could give you $6,000 or $8,000 or $10,000 a month, you could do that inside of 36 months.
Sounds like a whole nother webinar, Tom.
There's a lot to learn, right?
Yeah.
And with anything that's new, our confidence level has to grow. So we usually start with a smaller asset or two, start to learn how it works, why it works, and then we can step up into the bigger games.
Okay. That's exciting. You have any more slides to show, Tom?
That's it.
Why don't you click back to unshare at the bottom there, and we'll see your smiling little face.
Let me figure out how I do. Oh, there it is. Okay.
Should be at the bottom of your screen, Tom, where it said share. There you go. You're back.
Now am I back? Okay.
Yeah. And Tom, for the pleasure of the viewing audience, if you look at your camera on your laptop, whatever you're looking, then you'll be looking directly at them. So first of all, guys, those of you listening now, those of you who are listening to this recording later on, Tom talked about a lot. These are, I want to make sure you understand, these are Tom's opinions, and he's an expert in what he does. We suggest highly that you get the right team of experts together. You get good tax advice from the right person, you get good mortgage advice from the right person, good advice from the right team. These are not necessarily the opinions of Pacifica Mortgage or Bay Equity or myself or anything like that. We're bringing Tom on here so he can present his perspective, okay? Understand that. And if you have any questions, we're going to give you Tom's contact information at the end here so you can talk to him. Okay, Tom, so lots of information there, right? What amount of yield, I just got some questions that popped into my mind. What amount of yield can you expect at the different levels of the stack? So let's say you take the mezzanine financing, what yield can you expect there as opposed to you're the investor, I'm not sure what you called it exactly, but you're the investor that comes in with some funds that the manager puts together, and you're the third level up kind of thing.
So it depends on the type of asset. So if we were buying a stabilized apartment building, you would probably be looking at 8 to 10% returns. If you were doing a value add where you're buying kind of a Class C apartment complex, you're going to turn it into a Class B, and there's some risk to that. You're probably going to go into double digits, 12 or 14% returns.
Wow, that's exceptional.
If you were going to be, high risk equity partner in it, you would want to make 15 to 20% on your money.
Okay. And for those people who are in single family right now, and you said they hold them for 8 or 9 years, something like that, what are the next steps for those people? So let me start before I ask that, so we're talking about, let's say the real estate wants to be investor. They don't have a rental property yet. Maybe they own their home, maybe not. And they want to purchase a property as an investment property. What's the best way for them, do you think?
Well, certainly buying into your first house is always the hardest. You have to start saving up for that down payment or find a source for that cash that's not going to put your asset at risk. So if your parents had cash to lend to you or something like that, what you don't want to do is pull money out of your 401k or IRA. You would rather leave it where it is, save up and buy that first asset. I would actually say it's easier to buy an investment property with partners than it is to buy your own first residence.
Oh, and why is that, Tom?
So partners are interested in supporting your endeavors. So as long as there's a piece of the action for them, they want to do that. But nobody wants to invest money to just let you live in a house. because now you're talking about a growth-only asset.
Right.
Right? They share in the future appreciation, but unless you're willing to make them an additional payment on top of the debt service, there's really nothing in that for them.
Okay.
Whereas going to buy a fourplex, there are people everywhere that would jump on board and share that asset with you.
Okay. So does it make sense when you're getting started? I'm going to stay there for just a little bit, Tom. You're getting started. Does it make sense to combine all the tactics that we know as real estate investors, wholesaling, flipping, or getting partners and buying and trying to hold on to? What's the right mixture there, the right weight, or whatever? Is there an algorithm you use for that, Tom?
There isn't, and a lot of it is the skill set of the person. I would argue that flipping houses is not the easiest place to start. Not only do you need to understand real estate math, you need to understand finance, you need to understand construction. You have to be able to manage that construction. So flipping is not where to start. I think wholesaling is where a lot of people start because they don't have to make a commitment and they can actually get their feet wet in understanding the terminology and how contracts work and how to find deals. So wholesaling works as a way for you to get lump sums of cash to put into your bank so that one day you have your down payment saved up.
Okay. Makes sense. So to summarize what I hear you tell me so far, Tom, is that buying your own house first as an owner-occupied is certainly a great start because then you're getting into at least a growth asset.
Mm-hmm.
And there are zero down programs available or very low down payment programs available, guys, for that. And if you're living someplace, you got to pay rent anyway. So if you can get a mortgage that fits your budget and make that work, that's a great place to start. And if you don't have other investment properties and you're not quite ready to start swinging a hammer and figuring out how to rehab a home, wholesaling properties makes very good sense. And then, Tom, is there a certain amount of assets, liquid assets, you think you need to have before you move into the next realm, which maybe is buying rentals and using partners there? Or what's a good way to look at that?
Well, if you buy a rental, and I live near Everett, and a typical Everett rental might rent for $1,600 to $1,800. Let's just say $2,000 a month. You would want to have 6 months of cash in the bank for reserves before you would move on to saving up the down payment on the next property.
All right. And 6 months of what? What amount of reserves? Are you measuring your total cash flow or the payment for the new home or what?
I'm taking the operating cost, which is the taxes, insurance, repairs, vacancy, and adding the debt service to that.
Okay.
So if my house rents for $2,000 a month, but my payment and expenses come to $1,800 a month, I need to have 6 times $1,800 in the bank.
And ironic as that is, Tom, that's one of the measurements we use in the lending arena as well. And we like 6 months of, now it's a variety, guys, but 6 months of the payment is a real good benchmark for you there.
Mm-hmm.
There's a question from the participant, the attendees, Tom. How long should one hold on to a single family residence that's growing in equity, but not a ton of cash flow?
It depends. One of the greatest gifts the government has given us is the ability to sell our personal residence and walk with up to $500,000 tax-free. So if this house had been a personal residence and qualified, I would sell it just to get the tax-free $500,000. Use the $500,000 to go buy a $2 million something else.
Got it. Convince your spouse of that as well.
And not every strategy works for everybody's lifestyle. Certainly, if you have kids in school, you don't want to start switching neighborhoods and school districts.
Yeah,
so,
absolutely. Okay, so I get the owner-occupied thing and the 2 years there to be able to do that. But what about if it's an investment property? You're treading water with your cash flow.
You have to look at your yield on equity, and if you could get a greater yield by selling that asset and buying another asset that's bigger and better, then you should be selling it.
Okay. Okay, good. And I'm sure you place it in the quadrant there of the volatile versus non-volatile assets when you're looking at that and just kind of make a judgment decision.
You are. And certainly when you have significant equity in an asset, you can switch assets, move up, buy into syndications, buy into a partnership, do private lending. Private lending is a 12% cap rate right there. And if you learn to do it at the lower end of the capital stack, you have the least risk and the greatest return in real estate.
Okay, so let's spend a minute on that because I know you like that particular spot in the capital stack. What are the parameters around putting a second mortgage in place on a property that you like to see, Tom?
So if I'm doing a second mortgage, I don't want to invest too much more than about 85 cents on the dollar of value. The rest of it has to be equity. So if the first lender is coming in at 65%, I might come in with 10 or 15% up to 80.
Okay. So 80% is, so you're saying between the first and second mortgage, you don't want the total loans to be more than 80, maybe 85% of the value of the property.
Right.
Okay.
And if I come in at that level, I'm actually going to try to cross collateralize. So I have more asset to protect me than just the single asset.
All right.
Or I will have the entities, the LLC interest held as collateral. So instead of foreclosing on the property, I can just get control of the LLC that owns the whole property.
All right. So you're going wild on us here, Tom. I love it. Tell us what cross collateralization is for those that may not know.
So if I'm coming up with, let's say, $200,000 to buy my part of the property, I might want to get a $200,000 lien on another rental that they might have or their personal residence so that I not only have the single asset that I'm encumbering with my lien, I have a second property to also cover my $200,000.
Okay. And guys, I want to mention to you, there are laws around putting high yield mortgages on owner-occupied versus non-owner-occupied. So be very careful what you do there and talk to somebody who knows what they're doing before you do that kind of stuff.
Yeah, I agree. You need to do everything through an attorney, close through escrow, do it all straight up.
Yep, yep, and know your risk before you get into it. Okay, you're talking about buying into the LLC and as well as the property so you could acquire that. Explain what you mean by that, Tom.
So if we're going to buy, $1.5 million sixplex somewhere, and I need to come up with 200 grand in second position for my interest, I want that asset to be held in an LLC, and I want the equity partners to sign an agreement that says if they ever get in default on my loan, I have the right to take their interest from the LLC.
So you would effectively become the owner of the property through that process?
Yes. And I don't have to foreclose on the property, so I can take the assets back in 30 days instead of 6 months.
Is that right? Well, that's pretty clever, isn't it now?
Lawyers teach you this. So when you start working with lawyers, they have all these ways of protecting you.
That's a good one. All right. So we now own a couple of rental properties. It's been a couple, 3, 5 years, whatever. We have some reserves. We built them up. What's the next step, Tom?
To keep managing our portfolio to determine, is there another asset that we can buy of greater value with the equity that we now have? So if we have 2 rental properties and we've accumulated $400,000 in equity, can we sell those houses, take our 400 grand and put that down 25% down on a $1.6 million asset that now is going to appreciate greater, depreciate higher, and give us a little more cash flow than we're getting now?
Okay. Now, Tom, you've mentioned asset a number of times, and then on your matrix there, you had all kinds of assets and, different kinds of things other than real estate. Are you focusing on purchasing real estate as that asset right now because of the leverage there, or what?
Well, real estate right now can be a little tricky. Well, I think we're at the top of the market, and we're going to see things soften over the next year or two.
Wow.
Right? And so with that, you want to deleverage your entire portfolio. And there's techniques to doing deleveraging. That's a whole conversation apart from this. But I have clients who tell me, oh my God, I should be investing in cryptocurrency. It's the only thing that's going to make me wealthy. And you've seen history of cryptocurrency. When it fluctuates from $5,000 to $15,000 and back to $5,000, that is not a stable asset. That is a highly volatile asset, and no lender in their right mind is going to give you any level of debt against that asset. The secret to making money in real estate is the fact that it's easily leveraged. So when you buy a stock and the stock goes up 6, 8, 10%, you can't borrow against the value of that stock easily. You could do a margin loan, but that has its own risks. Real estate, you can borrow 60, 70, 80 cents on the dollar and amplify your returns well into double digits. So I like real estate because of that leverageability.
Okay. I'm tempted to go into the deleveraging thing you were talking about, Tom, but it sounds like that might be another half-hour long conversation. Is that correct?
It's really lowering the debt risk on the properties. And you could do that by bringing on equity partners.
Oh, so maybe you reduce the amount of the mortgage that's owed on the property by giving equity to one of your partners. Is that what you're saying?
Well, you have a partner that might buy in. They give you 200 grand. You use the 200 grand to pay down the mortgage.
Exactly.
Now your property has a lower loan to value and can make it through any slide that we have and come out the other end.
Okay. All right.
With that, you give up some of the future gains on that property.
Now, are you concerned? I want to talk about this a little bit because of 2009 and what happened there, and people who had properties that were debt servicing, as you mentioned, and people that had properties that were not. Are you concerned with the softening market that you are anticipating? First of all, define that. Does that mean, are we looking at a collapse in the market from your perspective, real estate? It's going to drop off the deep end, or just slow down some, or drop some, or what are you expecting?
Well, I think what happened in 8 and 9 was extraordinary, like once in 100 year, and it had more to do with reckless lending than any of the other fundamentals of the real estate market. I don't think we have that reckless lending taking place today. Now it's going to simply be the cycles of real estate where the time on market will increase. With that, there'll be better deals. You can actually find a little more distress in the market, so people are willing to lower their price so you can buy in better. You may also see less appreciation because there's that glut that will start to develop in the market. So where we've seen 8 and 10 and 12% appreciation in Seattle, we may see 4, 5, and 6.
Okay, so
now
you're
we're going to see a 10% slide back.
All right, so maybe a leveling off or a lesser increase in the values is what you're really anticipating.
Right.
All right, well, that makes sense to me. Okay, so if you are leveraged in such a manner that you have the debt service coverage ratio at a 1.15, you were mentioning 1.2 kind of thing, then you're pretty well set. And the reason I'm asking that question, Tom, is do you see the change with the softening in the real estate market, should it occur? Do you see a change in the rental market as well? Or will rents stay where they're at, which is kind of high for the Washington area, the Western?
So rents are more a component of the wage base. And so I don't see Amazon, laying off a lot of people in Seattle. So the high wage Seattle market, the rents are going to stay high.
Okay. Seattle and counties north and south and east and west of it, is that true?
Well, certainly, yeah. I mean, when you get into far north Snohomish County and south of Tacoma, you have less Amazon influence. So you have Boeing, you have Microsoft, you have Amazon. I mean, we really are blessed with some really go-get-'em companies out here.
Yeah.
But if I was in Reno, Nevada, I would have to rethink my math and what is worth doing.
All right. So you touched on something I was going to ask. So real estate is basically locally based in terms of the impact a lot. Like Reno, Nevada, or maybe a higher price. I don't know if you get a higher price here than Seattle, but there's still strong demand in Seattle relative to the real estate that's there. Is that correct?
That's correct.
Yeah.
I just saw an article this week in the paper that said millennials want to live in apartments because they don't believe it's a good deal to buy their own personal residence.
That's interesting.
So I find it interesting that a whole generation of people are going to forego this American dream that we've all grown up with because they think that owning an apartment is actually better for them.
I've seen opposite articles and heard opposite things. It'll be interesting to see how that develops, won't it? But certainly prices can price people out of the market. That is for certain. When Seattle is up there in the $700,000-$800,000 range for the median purchase price, it makes it difficult for a family of two who doesn't make quite the same wages that 2 engineers maybe working for Amazon or someplace to be able to buy a house. So it does get rather difficult.
Well, and when you look at the numbers, you buy an $800,000 house, you put $200,000 down, you're still paying $3,500 payments on the $600,000 of debt, and you might get $4,000 a month rent.
Yeah, there you go.
$500 is not a lot of cash flow for the size of an $800,000 asset.
Which harkens back to one of our previous webinars with Andrea and Gina, and they talked about investing in remote areas for that exact reason, guys. So check that webinar out or ask for a copy of it if you want. It all works together, doesn't it, Tom?
It does.
Yep. Okay, we've been on a little longer than I anticipated, but it was so interesting, Tom. Good stuff. Is there any parting comments, first of all, words of wisdom that you want to leave the audience with?
No, everybody should be managing their portfolio. What I see is people aren't aware of what they're doing or why they're doing it. Their realtor says buy it, they buy it. So they don't understand what they're buying and why they're buying it and what else is out there that they can do.
All right. And by managing the portfolio, you're talking about using the metrics that you just talked about to get the debt service in line and have the liquidity and things of that nature for proper growth management. Is that correct?
Yes, that's correct.
All right. Very good. Tom, it's always interesting to talk to you. I enjoy it a lot, as you know. If someone wanted to get a hold of you, what's the best way?
So email is probably best. And that email is tom@revest, R-E-V-E-S-T, strategies.com. tom@reveststrategies.com.
Very good. I'll put it up on the screen here so people can see it on the recording as well.
Okay.
Tom, thanks for your time. I appreciate it.
No problem.
I suspect we're going to do another one, and we're going to delve a little deeper into some of the stuff you talked about.
Yeah, let me know what questions come up. I would love to create another talk about another thing that people need to know more about.
Yeah, it's always fun. Thanks, Tom. We'll be seeing you.
Okay, thanks.